Hi, welcome back. The last two sessions, we looked at the first two strands of value investing. The first one, we looked at passive screening, where you look for low price earnings, low price to book, high dividend yield stocks, and you essentially buy these stocks and you hope that the price moves towards a value, that these stocks in fact go up over time. You're drawing on the empirical evidence these stocks tend to be underpriced and tend to earn higher returns, and on the hope that markets become efficient and rational over time. In the second strand, we looked at contrarian value investing, where you buy loser stocks. Loser stocks either because the stock price has dropped or because these companies are viewed as bad companies. And again, you sit and hope that something good will happen, that these stocks will reverse and become winner stocks again. In this third strand to value investing, I'm going to give you a little more power to make a difference. But I also have to tell you up front that this approach to investing is not accessible for most of us because it requires more capital than most of us have to bring to the game. And that's activist value investing. In activist value investing, rather than just buying cheap companies and hoping that something good happens, you try to change. You try to act as a catalyst. You try to make the price move towards a value or even change the value of the company. So if you think about activist investors, and they can come in different forms, there are at least three groups I could put activist investors in. The first are what I call lone wolves. These tend to be individual activist investors whose names are recognizable to most of us because when they challenge a company, they're upfront and open. Carl Icahn, Bill Ackman, Nelson Peltz. Even though they might have institutions they use, they tend to be investors who've been doing this for 20 or 25 years, and it's their personal presence rather than the institution that they represent that carries the weight. The second group of activist investors are institutional investors. Mutual funds, generally speaking, institutional investors are not activists either because they're too big or they have other fish to fry. But there are some institutional investors who are in fact activist institutional investors. They tend to be smaller, they tend to be more focused, and this is what they do, is they buy cheap companies and they try to change them. In fact, one of the very first activist investors was an institutional investor, the California Pension Fund, CalPERS, in the mid-80s. But institutional investors can sometimes play this game. There's a third group, which actually gets a fairly high profile here, which are activist hedge funds and private equity funds, which also come into these cheap companies, try to take a big position in these companies and change the companies. One big difference, especially with the private equity funds, is they often team up with the existing management, which creates a bit of a friction because it's these existing managers who are responsible for the state of the company now, which is it's not doing that well. And what they seem to be telling you is once they team up with a private equity fund, magically they become better managers. We'll set that conflict of interest question aside, but private equity and hedge funds try to also act as catalysts. Catalysts in the sense that they buy these cheap companies and they try to change their value or change the price to reflect what they think about these companies. So here's the essence of activist value investors. Passive investors, you buy a company at a value or a price, and you hope that, and if you think it's undervalued, you hope the price moves towards value. But there's not much you can do about it because you're a small investor or you don't want to make a difference. Activist investors buy the same stock at the low price, and they do two things. One is they try to create enough noise, enough publicity that the price starts moving towards a value. And sometimes, and this is where the creative part of activist value investing comes in, it's not even that there's one value. There are two values for a company. One is what I call the status quo value, which is the value the company run as is. And the second is, for lack of a better term, let's call it the optimal value, which is what the value of this company would be if it were run optimally, better, perfectly. And normally when you think about what the price is going to be a function of a weighted average of these two numbers. So if the market doesn't think there's much chance that the existing management will change, the price will be closer to the status quo value. And if you're an activist investor, here's what you do. You go in and buy at the price. You try to make the pricing gap disappear, which the pricing gap is between the price and the expected value. And then you try to make the value gap disappear by making the company better managed and better run. If I'm sounding mysterious, let's cut through the mystery. When you think about the value of a company, the value of a company comes from four key variables, and I talked about this in my earlier session on valuation. The first is your cash flow from existing assets, right? The second is the growth rate you're going to get from those cash flows. The third is your cost of capital or discount rate or risk based on the risk of those cash flows. And the fourth is when will your company be a mature company? When I think about changing the value of a company, the status quo value reflects how the company is run right now. The cash flows from existing assets, the growth rate, how long you will grow, and what your cost of capital are determined by the existing management's policies. So here are some of the questions you might ask as an activist investor. You could look at the existing investments and say, hey, can I cut costs? Can I take these existing investments and manage them more efficiently? Maybe by cutting costs and managing more efficiently, I can have higher income. And if I can reduce the taxes I pay or my working capital requirements, I can end up with higher cash flows from existing assets. It can happen, right? Lots of existing companies might not be efficiently run. When you look at growth from new investments, rather than take what the company is doing right now as a given, you could ask, do I have to invest what I'm investing now? Maybe I'm under-investing in this company if my return on capital is well above the cost of capital. Or in some cases, I might be over-investing and I should cut back on investment. If there is potential for improving efficiency, that's going to show up as efficiency growth. When you look at the length of how long you can keep growing, earning more than your than your required rate of return or your cost of capital, that's a function of what kind of competitive advantages you have. So there you can make a pause and ask, am I building on my existing competitive advantages? Are there new barriers to entry I can put up? And if you can find new barriers to entry or augment existing advantages, that lengthens your growth period. And finally, turn your attention to the cost of capital and say, am I using the right mix of debt and equity? Am I using the right kind of debt? Maybe I'm using short-term debt to fund long-term assets. Can I make my products and services less discretionary, which lowers my risk, lowers my cost of capital? If I have a lot of fixed costs, can I lower my fixed costs? So when you look at a company, you're looking at every dimension of value, asking, can I do something to change that dimension? And what you will focus on will vary depending on where in the life cycle you're looking at a company. So if you're looking at a young growth company, you're focusing primarily on that future growth, on 2. If you're looking at established growth companies, you're looking at 2 because you want more growth. You're looking at 4 because you want to build up your competitive advantages. You might even be looking at lowering your cost of capital. With mature companies, the focus is almost entirely on the existing cash flows from existing assets, which is 1. Perhaps efficiency growth on 3, and lowering your cost of capital. With declining companies, you're focusing primarily on the cash flows and lowering your cost of capital. What I'm trying to say is a cookbook approach to value enhancement doesn't usually work. What you will do will have to vary across companies, and a good activist value investor will know what he wants to focus on or she wants to focus on depending on the company that they pick for their analysis. So here are some of the things that you could do to change the value of your company. So you're an activist investor, you're looking at a company saying, what can I change? Let's start with the assets. Let's face it, in many companies, existing assets are not deployed in their best possible use. You're saying, why not? Why wouldn't managers already be doing the right thing? Lots of factors. One of it is, first is actually behavioral, which is if you're a manager who made these choices, you don't want to admit you made a mistake. So the fact is, ego and overconfidence often explain why mistakes stay on the books a lot longer than they should. The second is sometimes companies get into bad businesses because they did not factor in the risk of being in that business. So when they entered the business, they thought it was a safe business, or they assumed that because they were a safe company, they could enter into risky business and make them safe, and they discovered businesses are risky for reasons outside their control. Third is you can have companies that get into multiple businesses. This is what's called a conglomerate discard. Basically, when you're in multiple businesses, you might run all of them badly. So these businesses might have been good standalone businesses, but because you're running them badly, they end up being bad businesses. Fourth is might not be your fault. You might have gotten into a business when it was a good business. Now the business has shifted. It's become a bad business. And finally, macroeconomic variables can affect you. You can pick a good business and then inflation can go up or interest rates can go up and the business can become a bad one. What I'm trying to say is there are lots of reasons you can find bad businesses on a company's balance sheet, and you have to make choices. And here are your 3 choices. You can shut down the business and try to get whatever you can from liquidation. You can sell the business to somebody else, divest the business, see if somebody will pay you more. Or third, you can try to spin off or split off the business, make it a standalone business. What should you do? The answer is actually very simple. Do whatever makes the most financial sense. If by shutting down the business you get a very big liquidation value, it's real estate, maybe shutting down makes the most sense for you. If that business is worth a lot more to somebody else because they get synergy and other benefits, divestiture might make more sense to you. If the problem in the business you have is because it's part of a big conglomerate, by spinning it off and splitting it off into an independent company, you can make it into a much more efficient operation. That might be the best choice. So, with the given that companies can get into bad businesses, what you do with a bad business can vary widely across companies. Second step in the process, let's stop and look at the capital structure. The trade-off in debt is a very simple one. On the plus side, debt gives you a tax advantage. It's an interest tax saving. And the second is debt can sometimes make managers more disciplined in the way they pick projects. On the other side of the equation are three costs. The first is an expected bankruptcy cost, which is as you borrow more money, you increase the risk you will default. And there's a cost of going bankrupt, which can be both a direct cost where you end up in the legal system and it takes forever to get your assets out, or an indirect cost where people perceive you're in trouble and take it out on you. In other words, your customers stop buying your product, the suppliers stop supplying stuff, they demand cash. But that's the expected bankruptcy cost. And the more you borrow, the higher that cost is going to be. The second is an agency cost. What's an agency cost? When you borrow money, you create two claims on the business. One is from the equity investors who want growth and upside, and the other is from lenders who want to protect themselves against downside. And sometimes what's good for one might not be good for the other. How this manifests itself will be in the form of covenants that you get when you borrow money. Interest rates might go up. Essentially, lenders build in the cost that they see from agency prompts and pass it on to you. And the third cost you face when you borrow money is every time you borrow money, you lose some future flexibility you would have had if you hadn't borrowed the money. That's the basic trade-off. If the benefits exceed the costs, you should borrow the money. If the costs exceed the benefits, you shouldn't. You're saying, that doesn't help me though. That doesn't tell me whether I should have 20% debt or 30% debt or 40% debt. Well, I can help you on that one. There's a mechanism you can use to find the right mix of debt and equity for your company. And here's the mechanism. Every company has a cost of capital. It's a weighted average of the cost of raising equity and the cost of borrowing money. If you can minimize your cost of capital as a company, you maximize your value because it's costing you less to raise capital for your company. So if you look at different mixes of debt and equity, there is some mix of debt and equity at which your cost of capital is going to be lowest. That is your optimal mix. Here's an example. This is Hormel Foods in early 2009. It's a very conservatively run company. Hormel Foods is a mature food processing company. Its existing debt ratio is about 10%. 10% debt, 90% equity. What I've done in this table is actually compute what the company's cost of equity and cost of debt will be as they go from 0 to 10 to 20 to 30%, all the way up to 90% debt. Notice two things. First, focus on the cost of equity. As I borrow money, my cost of equity goes up. Why? Because if I'm an equity investor in Hormel Foods, the more they borrow, the more risk I see. The more risk I see, the higher my cost of equity. As I borrow money, my cost of debt will go up. Why? Because the lender looking at me will see more debt if I have 30% debt or 40% debt or 50% debt than if I have 10% debt. So cost of debt reflects my default risk, and as I borrow money, that goes up. I do get a tax benefit, and even though I lose some tax benefits at very high debt ratios, above 80%, that after-tax cost of debt reflects the fact that with the tax benefits, the cost of borrowing money is less than the cost of equity. My cost of capital is a weighted average. And notice something interesting. At their 10% debt ratio, they have a 6.79% cost of capital. They can keep borrowing money until they get to about 30 to 40% debt, because that's where the cost of capital is minimized. So I'm not saying you need to do a full table, but if you have a company with 2 or 3% debt and its optimal is 30 or 40%, you're leaving money on the table. You might choose to go out and borrow money if you're the activist investor, or push the management to borrow money because it increases your value as a company, which is effectively what I capture in the last column in this table. So if you have a company that has too little debt or too much debt, you want to change the way it's funded. And there are three ways you can change the funding mix for a company. The first is what I call marginal recapitalization, which means on new projects, you use a disproportionate amount of whichever financing you want to move towards. So you have too little debt, like Hormel Foods. On the next big project, fund it entirely or almost entirely with debt, and over time your debt ratio will climb towards your optimal. But that'll take a lot of time and require a lot of new investments. If you're a mature company, what's more common is what's called a total recapitalization, which is if you're at a low debt ratio like Hormel Foods, 10%, you want to get to a 30% debt ratio. Here's what you do. You borrow money, And rather than keep the money or invest it, you return it to stockholders either as dividends or in the form of stock buybacks. Your debt goes up, your equity goes down, your debt ratio changes almost instantaneously. And if you're not willing to do it, somebody might do it to you. And that's what you do in a leveraged acquisition. Somebody looking at your company chooses to borrow money based on your assets and uses that debt to fund their acquisition. So different ways of changing financing mixing. Again, the reason you do it is because you don't have the right mix of debt and equity. So you looked at what to do about bad assets, looked at what to do about the debt equity mix. Let's talk about dividend policy. Now, in classical corporate finance, it doesn't matter how much you pay in dividends because investors don't care whether you have the money in cash or whether you pay it out in dividends, because either way, they get a share of that money. What I mean by that is if you accumulate a $30 billion cash balance and I as a stockholder see my stock price go up by the percentage of that 30 billion that belongs to me, I'm going to say I don't care. It doesn't matter to me whether you pay dividends. And this is the basis for some of the arguments made by people who say, look, it doesn't matter how much a company pays in dividends. However, here's the catch. I've assumed that 30 billion in cash is valued by the market at 30 billion. You say, why wouldn't it be? If markets don't trust you, and this is actually from a study that looked at how much the market values a dollar in cash in the hands of typical US companies, it found that across all companies, a dollar in cash is valued at about $1. But here's the interesting difference it also found. When it focused in on mature companies, either companies with low growth, with negative excess returns, these are companies that earn less than the cost of capital, they have a history of taking bad projects, a dollar in cash is valued at about 69 cents. In other words, the market is attaching almost a 31% discount to cash because they don't trust you. Hey, if you're the manager of the company, market saying, give me the cash back. We don't trust you. And it's not your job to try to talk them out of it. It's their money. You've got to give the cash back. Now, there are other companies, high growth companies that earn well above their cost of capital, where a dollar in cash is actually valued at above $1. That company shouldn't be returning any cash. It's not being punished. In fact, it's being rewarded for holding on to the cash because markets view it as a good strategic weapon for these companies to have to either overcome the next problem they run into or maybe do an acquisition of an asset that they could not otherwise have done. So dividend policy can matter. And if you have too much cash in the sense markets don't trust you with your cash balance, then what to do with it becomes simple. You got to give the cash back, and you can give it either in the form of more dividends, and those dividends can either be regular dividends or special dividends, or you can buy back stock. Which one should you do? It'll depend on two things. If you pay regular dividends, for better or worse, investors expect you to keep doing it over time. So if you cannot sustain regular dividends, you either have to pay it as special dividends or as buybacks, because people don't expect you to do the same buyback year after year. On that choice, which one should you take? Depends on your investors. If your investors have never received a dividend, odds are they prefer stock buybacks over dividends because they don't want to deal with the tax consequences of dividends. If you're the kind of company that has paid big dividends historically, then maybe you should pay a special dividend. So there's no one answer that's going to fit every company, but the key is, if investors don't trust you with the cash, it's to return the cash back to the stockholders. Which brings me to the fourth issue. All of these problems in a company stem from the fact that managers don't always do what they're supposed to do. So if you think about corporate governance, the essence of corporate governance to me is you get to replace managers if they don't listen to you, if they refuse to change the way they run. And the best way to think about corporate governance is to value the company twice. Once is with the status quo value. Value the company with the existing management in place. Bad assets, terrible debt ratio, cash held in the company, whatever those policies might be. And the second, revalue the company with you as the activist investor running the company. That's the optimal value. Markets then make a judgment on what the expected value is by taking a weighted average of these two numbers, attaching probabilities that you'll be able to displace the existing managers. Now that probability can shift over time, either because activist investors mount proxy contests and challenge the status quo, or because somebody from the outside tries to make an acquisition. So sometimes you'll see a stock price jump on a company, not so much because the value of the company is changed instantaneously, but because the likelihood that the management will change can shift fairly quickly if markets look around and say, hey, you know what? In this company, the management could be changed. Look, there's an activist investor in the horizon. That's what I mean by catalyst. Essentially, by having enough capital and providing the catalyst, activist investors can act as their own agents of change, make the price move towards a value. So let's assume you have the capital to be an activist investor. You need a few $100 million, or you need to be able to find somebody with a few $100 million. So that's the first requirement. Second is, if you decide to do this, you really need to know the companies you're targeting well. In other words, you can't go in with diffuse views about what you're going to change in the company. You need to have a pretty clear plan about what this company is doing well, what it does badly, and what you would change, which means you also have to understand basic corporate finance. You can't go in with cookbook approaches to corporate finance. You can't go and say every company I'm going to take, I'm going to require a debt ratio of 50%. It doesn't work that way. That might work with company A, but not with company B. So you need to understand the basics of corporate finance. So if you've sold back your corporate finance book, go back and buy it back. Corporate finance is an incredibly useful skill set if you're an activist value investor. You have to be persistent. The first time you approach the status quo, the existing manager, and say, you got to change, you know what you're going to hear? Manager goes, no, we're fine. We do exactly what we've done for. The status quo is tough to shift. Inertia is a very tough force. You got to be persistent. The best activist investors hang in there. In fact, that's, I think, the big difference between the lone wolves and the institutional activist investors is the lone wolves seem to have a much greater persistence factor. The many activist institutional investors seem to give up too soon. And do your homework. You really need to understand the company and the business it's in if you want to change it. But if you can bring all those pieces to the table, you too can be a successful activist investor. So let's review. Unlike passive value investing approaches, in activist value investing, not only do you buy cheap companies where you think the market is overreacted, you then try to put in place the catalyst for that price to change. First towards what you think the expected value is, and then if you feel the expected value is too low, from the expected value to the optimal value. And that means you have to do the work of getting those changes to happen. And you can do that work by first understanding what you would change and then pushing for those changes with enough capital to make a difference. That's about it. Thank you very much for listening.